Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader show. For those of you tuning in for the first time, after my 30-year career on Wall Street as a commodities pit trader, chief market strategist at several firms, including 6 of my 10 years at Morgan Stanley, and the first to have taught behavioral finance theory at NYU, in 2018, I created In the Know Trader so that individual investors could learn the where and when that institutions make their investment decisions. I introduce models to you that you've never seen and have spent significant time teaching you how to use these models to better align yourselves and your own investments with what the most successful funds are doing. In today's show, we're going to look at the broad market as we do each week. And then this week, we're going to do a deep dive into the gold itself and the key components of the XAU index, which is the Philadelphia Gold and Silver Index. And that's probably the most commonly looked at index of stocks that are metals names in the gold and silver space. So we're going to try to get to as many of these as we can in the time we have together. Let me give you contact information, because each week I get probably, at least a dozen emails from listeners. It's rick@inthenowtrader.com, and just as importantly, our website, inthenowtrader.com, where you can find lots of videos on a variety of things that are important to you as a trader, as well as information on how to subscribe to In the Know Trader. Let's start off some analysis, as we do each week, comparing the 11 S&P macro sectors, how they are as of last night's close versus the S&P. So all the numbers you see are relative to the S&P this year. And on the right-hand side of this slide, we have in the past week. And on the left-hand side, where it was 2 weeks ago. What we'd like to do each week is compare movement in these sectors to see what's kind of going on underneath the market, not just where the S&P is on a whole, which we do each week too, but kind of what's moving. So I've highlighted the sectors on the right-hand side with either red dots or green dots, indicating a movement of 1% or more from the prior week in relative performance. Red dots means that the sector has fallen 1% from the prior week, or 1% or more, and the ones with the green dots have outperformed by 1% or more relative to the prior week. So we see that consumer discretionary on the far left side is up 2.19. It had been up, looks like about 4.7 or so. So discretionary names got hit hard last week, as did communication services, now down on the year relative to the S&P. They had been up 2.75%, so they got clobbered by over 3% in a single week. Technology, kind of nothing there. In fact, let's move to what has dots. Energy, the dog of the year, down just about 20% as of last night's close. A week ago it was 14.77. So again, a tremendous difference in the course of a week. Healthcare, still the second worst in the week, but actually that should have had a green dot, because now it's only down 10.4 versus it had been down 13.4. So my error for putting a red dot, it's a green dot. It actually improved itself over the last week. Utilities picked up quite a bit too last week. A good about 2.7% of outperformance. Financials went from underperforming to outperforming by only a small margin. And real estate, the second best performer of the year, is up 14.34 versus it had been up 11%, so a pickup of 3% or so. So lots of movement going on in the market. Last week, the S&P was up for its second week in a row. It was not a big increase on the week. But again, even now as we speak, the S&P is trading at 3,011. That makes it only 17 points from all-time highs. That's just above 0.5% away. So given all the stuff going on in the world, all the potential negative news that can still impact the market negatively, this index, which is really the most respected and used index to look at what's going on in the U.S. stock market, is just a few points away from all-time highs. So just think about how high this thing could be if we didn't have all the negative trade talk issues that we have, the potential impeachment issues that we have, the Fed either further cutting rates or not cutting rates, issues in Hong Kong now, just general political or economic issues that, and of course, the big one is that 3 out of 4 economists think that a recession is coming next year. So just think of how high this market could be if we didn't have all those issues in the way of us. All right, so now let's move and take a look at our charts. And let me start off with, before we get to the gold names, let's take a look at the S&P. And you can see here just how close we are to all-time highs today. Here we are trading at 3,010. So here's the big thing that I've talked about before. I've made a big point to institutional clients about this, and also in the no trader clients, again, the individual investor clients in our newsletter. We are getting another sequential upside exhaustion signal. Again, this is the model that Tom DeMark developed in the 1970s. You need special software to be able to access this model. But basically, when we see these signals, it often is implying exhaustion of trend. In this case, it's uptrend. So you can see in July, just before the all-time highs were made, this says exhaustion of uptrend. We're here again now, and it's somewhat concerning to me that we have a second signal still beneath what's the all-time highs that was here in July, on July 26th, which made the all-time high at 3,028. So here we're getting another upside exhaustion signal beneath the price of where the all-time high is. And if we looked at a weekly chart of the S&P, we've been in the context of a weekly 13 signal since the summer. So now we have another daily signal showing up for upside exhaustion while we're in the context of a weekly upside exhaustion signal. So we have multiple time frames saying the same thing. Now, does that mean the market can't go higher? No, not at all. What it implies, however, is that the risk of first adding new longs here is quite high. And that's the way I'm looking and interpreting the model. So aggressive traders could and often will short against these 13 signals. I'm not suggesting we short, because I actually feel like the market can still go higher. The fact that all this bad news is out there and we're virtually on all-time highs tells me there's still pent-up demand for U.S. equities, and that the likely course of action can still be higher. However, the risk to first putting on new longs here north of 3,000 is quite increased. And you can see, for instance, back in July, when we were, even on July 26th, or here, let's go back to the day, July 15th, that this 13 signal came in. That was all-time highs that day. And just a week and a half later, we actually put the peak in it, and then we dove into August. And we had that whole back and forth range in August. So one of the beauties of this model is because it doesn't need a lot of other information that other models do. So let's say here, even look beneath at a MACD. The crossover, well, here is pretty darn close. We did get a negative cross, very close to what was the all-time highs, but a lot of times you don't, because moving averages are lagging indicators. So whether you look at RSI, stochastics, Fibonacci retracements, a whole bunch of things, they often cannot nail the turn at the time of the actual turn. They're lags. And sometimes that, a lot of people don't mind seeing a stock that peaked at 100 and getting a sell signal at 82, let's say, and saying, okay, it peaked at 100, it's 82, it's coming off, we have new signals, time to get out of something. Well, the difference is you've lost almost, let's just say 17% of a move before you actually got a signal. This signal this model is devised to actually be able to call very close to the true turning points of a market, and that's why we use it. That's why institutions use it, and this is why they're actually often selling. When you're buying on something that looks like a breakout, they're often selling, or certainly not supporting the rally. And the whole goal, as I mentioned in the intro here of In the Know Trader, was to help align individual investors to be on the same side as institutional traders. So when we look at the S&P now, what this says to me is very high risk to first buying here and now. So I'm not going to be adding new long exposure here north of 3,000. I'd wait for a pullback. If I still think the market can go higher, I at least want to wait for a pullback. Between current price of 3,010 and 3,064, which is about another 2% higher, I have that as a dead zone. And even though the media is going to, if we break above 3,028, you're going to see a million headlines that the S&P is on all-time highs. And factually, that's correct. Anywhere from current price up to 3,064 is kind of this dead zone. And until you get above 3,064 properly, which is the weekly stop out level to its own 13 signal, you're kind of in no man's land up here. And I pay less attention to what the media says and more attention to how institutions play and what I'm advising my institutional clients. And I have a very well-read piece across some of the most continuously successful funds on the street. I am advising them not to be material buyers up here and not themselves to get hooked into what they hear the media say. So that's my take on the S&P as far as the upside. What's critical on the downside? The same thing I've been telling you for a few months now. Proper closes, qualified and confirmed daily closes beneath 29.11 and or 28.88 is my exit point. That is where I hedge up books. That is where, despite the fact that August, we saw multiple times that we were beneath this line of 29.11, this purple horizontal line, we never broke beneath it properly. Again, in a qualified and confirmed fashion. If you're not sure what that is, you could probably look it up online and look up DeMark qualified and confirmed, or go to our website and subscribe. We write about this all the time. This level has not properly been breached, nor has 28.87. These are the two key levels I'm looking at. And until they properly get breached, I stay long the U.S. equity market. If we breach these levels now, that's when I hedge my long books and look for a bigger move down. And at that point, that probably comes because one of these bad headlines that we're talking about, whether it's recessionary indications, whether it's a China trade deal that blows up, whether it's something that truly happens with an impeachment process, whether it's the Fed doing something unexpected and the market coming off this time and each time since late July, if we get that proper signal, then I finally get out of the market. So that's my take on the S&P. If it breaks out to the upside above 3,064, my next target is 3,120 to 3,136. And beyond there, I think we're talking about the 3,300 level sometime well into next year. So that's our take. Let's now focus on the subject at hand, which is the gold market. So we're going to look at gold futures as our indicator. You could look at GLD. It's going to look very similar, not exactly the same because it doesn't have the roll function of futures where contracts expire and then readjust for price for the new one. But let's look at this in the big picture. And I actually, here, I'll tell you something. So we had institutional clients long from just after this weekly 9 count in the spring. So we were long at 12.90. Actually, we got long a little before there because we got long at 12.95. Watch it trade down maybe $20, $30 or so. Here, 12.67 looks like the low of the move. So it was about $28 against us. But I was anticipating this breakout, and sure enough, finally we get this breakout from 6 years of pretty much going sideways. The real breakout level was just about 1375. So if you look at the highs in here, there's 1377. Go back a little farther, you had 1388 back in 2014, and round numbers 1375. The low of the move in round numbers was 1050. So we had a $325 range for 6 years, of which we busted out to the upside. So if we add $325 onto it, eventually somewhere, well, here, let's just put this level here. $1,700 would be the measured target for the S&P over time, and that's where I think we are going over time. But my initial target zone was this level in here, 1487 to 1532, which had to do with the last high made before it broke down in 2013, as well as the breakdown point where multiple levels, multiple times, we had seen just about 1432 be the low. So that was my target zone, and we got out into this range. And I did several public appearances about saying time to sell gold. And I got a lot of flack from people saying gold's going to 2,000, gold's going to 3,000. And the thing is, we still have not had a single weekly close above the high end of this range of 1532. The move got to 1566, but we still, front month futures closed within the range. And to this point, still, we have not broken out to the upside, again, above the top of this range. If we do, yes, I want to be long gold again. Excuse me. On the downside, let's take a look at a daily chart of gold. And now what I'm going to do is put up the cloud chart, and let's blow this up. And here's, to me, the real kind of kit and caboodle. Notice that in the last few weeks, the bottom of the cloud, even including today, is the low of the move. And when it broke into the cloud back in September or early October, we still held the bottom of the cloud. The cloud was just at a different level. So now I look at where it is, and again, it's kind of very close to today's low, somewhere right around 1483 in front month futures. So that would be December gold futures. If this finally breaks, you can see from the tomorrow counts, by the way, just near the all-time high, right, upside exhaustion signal. We don't have any down counts to say that we're exhausted to the downside. So this certainly can still get a break here. And the speculators in the market, if you look at the Commitment of Traders report, are long 4 contracts of futures for every one they're short. So specs are absolutely long. The natural hedgers, the people who are in the gold industry, who are gold producers who sell forward inventory, or the natural sellers of a futures market, are short 7 to 1. And that normally means that the underlying price is going to go lower because the hedgers are considered smart money, not the speculators. And the funds, basically what this says is funds are still quite long. So it's very possible that we still have weakness here. If we come out through the top side of the daily chart, it's not that far away from where the top side of that 1532 level was. So, you know, I don't mind giving up $40 worth of gold on the upside. If I'm still playing for 1,700 over time, I don't care if I miss out 40, but I want to make sure that if this thing falls apart, that I'm not stuck long. So over the next 2 weeks, if it broke, the key level is probably about, I'm going to say 1440. And that's going to be where the cloud's lagging line, this blue line, which is what current price push back 26 bars is. And that's I didn't make that out of thin air. That is the part of the Ichimoku model. In a couple of weeks from now, that's where if we break in price, then this blue line is going to need to hold against the 1440 level here. Because if that breaks too, then you have a better chance for move to the low 1400s. So that's gold in a nutshell. Now let's get to the actual key names in the gold space for those of you who like to buy gold mining stocks as compared to bullion itself. We're going to start off with First Nevada, ticker FNV. And we're going to look at all the charts we look at now are going to have a purple line that represents the 50-week moving average and a green line which represents the 200-week, most of them, or when I find that the cloud will be helpful. In this case, it's not terribly helpful, so I'm going to take the cloud off. Oops, that's not what that did. There we go. All right, so you're also going to notice that as many gold charts as we can get through, and then many of them look very different. This is definitely one of the best charts in the space. So It also has yet to get a proper decline beneath its propulsion sell signal here at 94.25 or so. If it got that, it would target 87.26 and then all the way down here at 73 and change as its downside targets. So the way we play this is, if you're looking to get long this name, I'd probably look to buy a pullback to 87.25 area. And here, I don't think it'll go much lower. If it does, yeah, then it'll probably test the 50-week. But the 50-week really hasn't been, I mean, it did catch a couple highs and lows. Well, no, it actually, in the last year and a half, it has meant something. So I would say 87.25 to wherever the 50-week is at the time is probably where you're going to find support in the name. Notice you already do have a MACD negative crossover. So if this thing starts moving up, you're going to want to wait for a bullish move to the upside on a crossover in order to get long the name. Next, IAG. That's IM Gold. All right, notice this is not near its highs. Excuse me. And but this does have a trading pattern of turning off of 9 counts, set up 9 counts. 9 weeks in a row close above the close from 4 weeks prior, or 9 weeks in a row that the close on a Friday is less than the close from 4 weeks prior. When you do it 9 weeks in a row, you often have a turn. And you can see the turn was made here on the top, the turn was made here on the top, here's a bottom, here's a top. This one has kind of been somewhat steady since, broke down one more time, 9 bottom, 9 top. This tough name to trade. This is short-term, you know, you get kind of 2-month moves and then it really stops going. If we get multiple Friday closes above 4.33, then I'd look for it to challenge its all-time highs. Next, let's look at, what do we have here? Nope, wrong ticker. Yamana Gold. And, you know, this is a very low price stock. So let's blow it up a little bit. You can see the same similar, not anything close to all-time highs. Recently bottomed on a 9 count, topped on a 9 count. It's gone nowhere since. Got no real signals on the downside. If this gets above 394 and a couple of Friday closes, look for it to get to 492. That may be the best move because that's $1 on a $4 stock. So that's a potential for a 20% move higher, you know, if you can get through there. On the downside, I can't even say that the 50-week necessarily is going to be support, but I'd say middle of the range if you're looking to buy it, maybe somewhere near 265-ish, give or take. Next, we have Wheaton Precious Metals, WPM. So this has a longer-term double top. 2016 and 2019's highs are virtually the same price. Here, let's take a trend line, shoot it across. And you can see basically double top, 13 signal thing, upside exhaustion coming in a few weeks before that blow off top. To me, anything beneath 23 is where you want to be a buyer. If that opportunity comes over the next few weeks, you'll have both the 50-week and its propulsion exhaustion signal in the same place. This actually has an active propulsion sell right now. So it is, in the way I look at it, it is not a buy until this sells down further. You also have a negative MACD cross working against you. Seabridge, SA. This is, look, we're very close to its 200-week moving average. 13 high here, 9 high, or 9 close to the high. The highs here this year are just above the highs in 2016. This has not been beneath its 200 weeks since back in late 16. So I'd say anywhere from just about, well, these are big percentages because they're low price stocks. Right now it's trading 1187. Let's say, where's that? See, I'm just trying to get the value of, maybe I could do it this way. Okay, 1165 is the 200 week. So anywhere from the 200 week down to 1105 should be support. And that's where I'd be a buyer here. But realize if you look back in time, that's assuming gold really continues higher. Because otherwise this could come all the way back down to the bottom of the range down at $8. That kind of matches here. So maybe I'd buy some, but not as good looking as some other names. Let's look at GOLD. Barrick Gold, right? One of the biggies. 13 bottom here in the summer of 18. 13 top, a little before the all-time highs, but we're trading beneath it on critical support here. let's see, how many weeks is this? Yeah, last week was not close. If this Friday closes less than 1658 and gaps lower Monday morning of next week, it would actually suggest it can go lower. At the same time, it's going to, unrelated to that, it's going to have a DeMark 9 count, and I'd say that I'd look anything near $16 here, $15.50 to $16 to get long the name. Again, if you want to get into the precious metal space, PAAS, Pan American Silver. Okay, so this is a silver stock, not a gold stock. Multiple tops here. Look, between 18 and 19, going back several years. I'd wait a couple weeks, buy this. If you can buy this under $15, I'd look there to buy it. But this, you are going to have some overhead resistance just from years worth of buyers who are somewhat trapped. You really have to like the space to like this name. Next is Eldorado Gold, ticker EGO. Too many people on Wall Street have a big EGO, doesn't serve them. So here's this peaked perfect again. You wonder how institutions do as well as they do, and why is it that when something looks like it's screaming to the upside that you buy, it falls flat in your face? Well, it's because you probably don't have access to this model. And again, this is just one model institutions use, but they absolutely use it. There's a reason these things stop where they do. On the downside here, I'd look for support near 665. That's still $1 lower than current. I'd wait a couple weeks, see if gold breaks. If it does, you should get your chance to kind of come back into that level. And I would say the mid-$6 figure is the place to be. I'm going to skip a couple of the other names in the list just to get farther down to get to some big ones. Newmont. I'm sorry, this New Media. That is the wrong ticker symbol. Let's switch to Freeport Mac. All right, so Freeport Mac, most people think of Freeport Mac as a copper play. It's also a gold play. And you are starting to see a base here. You've got weekly 13 spread out over several months. In fact, you've got 3 of them suggesting downside exhaustion is at hand. This is a name that I think, now again, I like copper right now. I have institutions long copper, and it has a gold component. This is a name that I'm guessing in fundamental terms is cheap. I can't be sure because I'm not a fundamental analyst, but I'm guessing it's probably cheap. This is probably one of the best names I'd like that's been beaten down as compared to buying into strength. So we probably have time for one more. Let's do Harmony Gold, HMY. And so here, multiple 13s along the bottoms over the last year or so. This has moved up nicely, stalled right by the propulsion level. Holding actually has an active sell one on the downside. You either buy weakness if gold really does get a flush out. You buy weakness down towards the 50 and 200 week moving averages in the low 2s. Otherwise, you could get long above 340. Multiple Friday closes above 340 gets you 4 and ultimately 5.25. That's it for this week. Hopefully, you got a good sense of what's going on in the stock market and the gold market. I am Rick Bensignor for In the Know Trader.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.